That's really the result of rapidly rising interest rates and the impact it might have on portfolios of fixed income securities. So we look at corporate bonds really as an example of this risk because all fixed income securities are subject to it to varying degrees. But we thought it might be helpful to highlight this with corporate bonds. So we went back and looked at in the last 20 years, the worst credit experience of a portfolio of BBB rated corporate bonds, and we found that the credit loss was about 0.5% during 2002 when there were a lot of corporate defaults. So what we wanted to do is contrast that with what would happen in a rapidly rising interest rate environment. And so we assumed a 200 basis point or 2% increase in interest rates, which really brings us back to the beginning of 2011, and we found that an average 10-year bond would lose 15% in value immediately. If interest rates rise very quickly, they're obviously much more significant than if they happen slowly, where investors can adjust their portfolios, adjust their businesses. But what we've seen over the last several years are more bonds being issued as fixed-rate securities, less as floating rate. So investors in general are holding more securities that won't benefit from increasing interest rates. And so if interest rates move up very quickly, we could see losses in portfolios.
Nominal exposure differs from economic risk. If you look at the largest investor in terms of nominal exposure, it's U.S. life insurance companies, which hold about $2.1 trillion in U.S. corporate bonds. But life insurers have important mitigants. So for one, they engage actively in asset liability management, meaning that they match the duration of their assets with the duration of their liabilities. Also, the regulatory capital is based on book value rather than market value, so market value losses wouldn't impact their capital, and they tend to be buy and hold investors. Now, that said, there could be specific outlier companies, for example, insurance companies that go longer out on the curve in terms of the duration of their assets that could face problems in a rising rate scenario. Now contrast that with hedge funds. While there isn't particularly good data on the U.S. corporate bond exposure of hedge funds, then because they tend to be leveraged investors, they could face more extreme pressures in a rising rate scenario. So take, for example, a 50 basis point interest rate rise. In that scenario, the market value of a typical BBB bond would fall about 4%. Now, if a hedge fund were to purchase that bond on margin, so let's assume a 10% margin rate, that would be 10-to-1 leverage, meaning that 4% loss on the bond could translate into a 40% loss on capital. If rates were to rise relatively gradually over time, there might be very little impact on market liquidity. But in a scenario where rates were to rise more rapidly, more drastically, then that could create broader distress within fixed income markets. And there could be other factors that could exacerbate those risks. So, for example, the major primary dealers held about $230 billion in U.S. corporate bonds in 2007. That number's come down to about $50 billion currently. So those lower inventories imply lower liquidity, which in a distress scenario could amplify some of the distress selling and some of the liquidity-related valuation losses. Now, one question is, why have those inventories come down so much since then? And one contributing factor is likely the impact of regulation. So, for example, if you take Basel capital and liquidity rules, they've been designed to help curb risks in the trading book, but an unintended negative externality of those rules is that now you have lower dealer activity in some important markets, and that in turn could exacerbate liquidity pressures.